Fire insurance has become one of the most urgent issues facing homeowners in San Diego County and throughout the state of California. And unfortunately, it's one of the issues my office, we receive a lot of calls, but unfortunately, we can't directly fix this at the county level. This is a state issue with the state insurance, and so we're going to hopefully find out what can be done and what the state's doing about it. And we're going to have time for questions as well from folks. So the authority rests with the state on this issue, but that doesn't mean we're just going to stand by. Over the past year, we've heard from residents who've been seeing their premiums skyrocket. I've seen my own people being dropped from coverage or forced into the FAIR plan. For some, insurance is no longer affordable or even available. So this is an issue we're trying to deal with. So clearly, the current system isn't working, but it's time for real solutions. And tonight, we're fortunate to be joined by Sharon Smith. She's a representative from the California Insurance Commissioner's Office, and she's going to share with us tonight about what the state is doing to address the crisis and what relief might be on the horizon. So here's how we'll go tonight. We're going to begin with a short presentation from Sharon, and then we'll open it up for questions for her. And so without further delay, please join me in welcoming Sharon Smith. Sharon, take it away.
One second, just making sure everyone can see my screen there. Second. Hey, thank you so much for the introduction. My name is Sharon Smith. I am an outreach analyst for the California Department of Insurance. I've been working here for the last 2 years or so. And I've seen, especially in San Diego, the effects of, which I'm sure you're all experiencing to some degree, of insurers leaving the state or limiting coverage or raising premiums. And so what I wanted to do today was really take some time to explain what's going on, what the department is doing to address these issues. And I think the most important part before we dive into exactly what the department is doing to address the crisis, I think it's important to just understand the factors that went into the way we've gotten here. And none of this happened overnight. It might seem like it did, but there's been several key factors that have really been driving these changes. The increasing severity and frequency of natural disasters, as well as rising global inflation, has really put stress on the insurance industry nationwide, not just in California. But here, the cost of rebuilding homes and businesses has surged. We have rising prices for materials, labor shortages, and supply chain disruptions. So all of that is creating an even more intense system there. So other part of this crisis is that reinsurance. So insurance companies also buy insurance. So reinsurance is just simply insurance for insurance companies. This is also becoming harder and more expensive for insurance companies to retain. So they buy insurance to mitigate their risk and continue to be able to buy in these or continue to write policies in high risk areas. But the insurance that they rely on is also becoming more expensive. So as risk is growing and the insurance market is contracting to protect financial stability, we're starting to see these ripple effects in policies. So it's important to note that insurance companies are not public utilities. These are not nonprofits. They're looking to make a profit, and they are not legally required to offer coverage. The regulatory framework that we have in California, you might have heard of Prop 103. It was passed by voters in 1988. It hasn't really kept pace with the changing regulatory and kind of insurance market. These regulations have basically been stagnant since they passed in 1988. So recognizing this, the commissioner has taken steps to modernize these outdated regulations and create a more resilient insurance market. Which brings us to the sustainable insurance strategy. Due to the pressing challenges in the insurance market, the commissioner is worked with the governor, got his support on an executive order, and announced the sustainable insurance strategy in September of 2023. This initiative introduces a series of regulatory reforms aimed at increasing availability for Californians, creating a more resilient insurance market, and protecting communities from the growing risk of climate change. The key initiatives under this strategy include streamlining and improving the department's rate application approval process to reduce the delays that we experience and ensure that insurers are able to adjust to changing market conditions more efficiently. Second, we've introduced new risk management tools in rate making, such as catastrophe modeling and the incorporation of reinsurance costs. These tools will allow insurers to assess risk more accurately and account for wildfire mitigation efforts. Finally, increasing the availability of insurance in wildfire distressed areas was a key part of the initiative. We've required insurance companies to write more policies in high risk zones if they want to use these new tools. So they need to be able to close that growing reliance we have on the FAIR Plan and ensure that Californians have access to more traditional insurance options. And I'm going to go into all of these a little bit more in more detail, and then we'll have questions at the end. So a lot of what I'm going to talk about next might seem a little detailed, but I think it really makes sense to understand what's happening in the insurance marketplace, especially in California, is to understand what is going on with our Prop 103 kind of rate review process. So at the core of Prop 103 is the department's rate review process. So anytime an insurance company wants to raise rates, they have to go through a rate application approval process. By statute under Prop 103, the department must approve these rate applications within 180 days upon receipt. In reality, that almost never happens. Some rate reviews have taken over a year to be approved due to multiple factors causing delays. Insurers often submit incomplete applications, leading to back and forth exchanges that can take months to resolve themselves. And we have been working with some really outdated technology at the department and staffing limitations exacerbated by COVID that have really further slowed this process down. So what the department's been doing is hiring additional staff and developing new data and reconciliation tools to be able to move this process along more quickly. Additionally, something that really impacts rate reviews and delays is California's unique intervener process. So in California, there's no other state has anything like an intervener process, but consumer advocacy groups or consumers like yourselves can log onto our website right now and intervene on a rate application. So if you believe it is excessive, if you have your insurance company, you see they have a rate filing, you can intervene on that as a consumer. And if you're successful in intervening, you can recover your legal fees from the insurance company to go through this legal process. And no other state has anything like this. So this is really unique to California, and what additionally increases our delays for these rate filings. And it's important to note when Prop 103 was written, it had great intentions of giving consumers a voice and increasing transparency and consumer protection. But it also has kind of like the double-edged sword here is that it has led to a lot of delays in the rate approvals, and insurers and interveners go through very long, lengthy legal negotiations trying to come up with resolutions for some of these rate reviews. To work around these delays, and so insurance companies were not having to go through this rate review process, what they were doing for several years was actually asking for rate increases that were 6.9%. So they'd get it approved 6.9% rate increase, and even the following day, they'd ask for another 6.9% rate increase. Why 6.9%? That seems so arbitrary, but 6.9% is right below the 7% threshold that could trigger a public hearing. So this allowed insurance companies to avoid these extended delays. And it created a really inefficient process where they were getting these smaller rate increases instead of the increases they probably actually needed, which were likely much larger. And getting that single necessary adjustment, we were going through, again, this really inefficient process. So this was something the insurance commissioner, when he came into term, was like, we can't do any more of these 6.9% rate increases. We will look at the company's financials. We will actually take into account what rate increase they actually need. and go that way, as opposed to doing this really inefficient process. So why am I talking about this? Why does it matter that rate increases take a really long time? So if rate adjustments are delayed and are lagging behind rising costs, especially as we have these climate-related incidents becoming more frequent and severe, insurers start to face financial instability. They start to leave the market, they start withdrawing from high-risk areas. So without these timely rate reviews, then homeowners are left with fewer options and having to resort to the FAIR plan, which is the trend that we've seen. And this is the trend that we're hoping to reverse with the sustainable insurance strategy. So the department is really addressing the challenges by working on streamlining these processes, but still maintaining consumer protection. So we know that rate reviews need to happen in a timely fashion so that insurance companies can accurately price risk and continuing offering coverage. But we still need to balance that with affordability challenges and consumer protection. So like I stated before, we're hiring additional staff, we're improving our technology and trying to increase transparency in these intervener processes. And we're also committed to making sure that insurance companies submit complete rate applications before they can actually get started on the rate review process. So again, the goal is kind of balancing that consumer protection and transparency and also making the necessary adjustments to keep coverage available. Next element of the sustainable insurance strategy directly addresses the climate crisis. So up until the sustainable insurance strategy the regulations were put into place in December, the way that insurance companies set rates were based entirely on historical data. So they would look at the last 20 years of data, what happened during those 20 years, what their losses were, and that's how they were setting rates. Now, using just this kind of historical data causes two different issues. On one hand, past losses are not going to accurately reflect the increasing risk that insurers are facing today, especially with climate change driving these more frequent and severe natural disasters. And then the second part is that this method really failed to recognize any mitigation that was done by homeowners or by communities, because any investments that they were doing in wildfire prevention were not being translated. They weren't being reflected in the insurance rates that insurance companies were able to set, because they could only use that historical data. So to address these challenges, new regulations were finalized in December that allowed insurance companies to look at to utilize forward-looking catastrophe modeling that would prioritize wildfire safety, mitigation, and transparency. So effectively addressing the climate change crisis is going to require modern risk assessment tools and strategies that's going to ensure that insurance remains available and still encourage proactive wildfire risk reduction and mitigation. So insurance companies are required to use these CAP models that recognize the clear benefits of investments made by wildfire mitigation. So it is really important to still do that mitigation because that's going to be reflected in this modeling. You know, the home hardening, fuel reduction, prescribed fires. These are the types of data that's being included in this modeling effort. And in the long term, by incorporating this future risk projection and these mitigation efforts, these models are going to create a more fair and more accurate system that rewards policyholders for reducing their risk and also helps stabilize the insurance market and continues to ensure that we're getting more insurance availability in these high risk areas. And I think it's important to note that we're not reinventing the wheel here. Most other states do have and do allow insurance companies to use catastrophe modeling. But because of Prop 103, California had to comply with a lot of public transparency regulations before we actually were able to implement any of these changes, which kind of also led to a lot of delays. So we held a series of public webinars in 2024 to gather input, and this helped us refine these regulations, but it's been a long process to actually getting to a point where they've been put into place. And so again, important to emphasize that if insurance companies want to use these CAT modeling tools, they have to commit to writing in wildfire distressed areas that the commissioner identified. These wildfire distressed areas in San Diego, too, were identified: Alpine, Ramona. They're going to be reevaluated every year. But for now, those were the ones that were most impacted in our San Diego County. The other part of the sustainable insurance strategy was that the commissioner also submitted a regulatory change to allow for insurance companies to incorporate reinsurance into their rate making. So again, reinsurance is a really critical tool that insurance companies use to manage their risk and continue writing policies. But like I said, this reinsurance has gotten more expensive. It's become harder to obtain. And insurance companies have said for a long time, if they're not able to incorporate these costs of reinsurance, they're not going to be able to continue writing in California. So the insurance commissioner made sure that these regulations really only incorporate California only reinsurance costs. So we don't want to be paying for reinsurance of, actually covering the entire United States or all of these insurance companies' market share. We want to be paying for the risks that they're taking on in California. So again, if insurance companies want to use rate making, if they want to use CAT modeling, they have to commit to writing in these wildfire distressed areas. That's going to be a key part of them being able to use any of these tools. And reinsurance is another tool that insurance companies have basically been able to use in every other state. But because California had a very different regulatory environment up until these regulations, it was something they weren't allowed to incorporate. So it's a really big change that insurance companies have wanted for some time. And we're hoping that with these changes, we're going to be able to get more increased availability across the state. Now, what's next for the sustainable insurance strategy? At this point, the regulations are in place, so they're on the books, but this doesn't mean that insurance companies can use catastrophe modeling today. So because again, Prop 103, I'm going to keep harping on Prop 103 because that's kind of the framework that we have to work within at the Department of Insurance. We have to have some really extensive public participation around these CAT models and around what actually goes into them before insurance companies are able to use them. So the catastrophe models currently are being reviewed. There's one called Barris, there's another one called Moody. We're hoping that these are going to be completed and reviewed by the end of the summer. At that point, insurance companies are going to tell the department, hey, we're the Department of we're the X company, we're going to use this catastrophe model, and this is how it's going to affect rates. And then we start our regular rate review process. Once that's complete, then it should trickle down. We should approve or deny based on the actuarial findings of our rate regulation department. And then we should start to expect new policies once those rate applications are approved. So if you think of it as like kind of a three-step process, we're at step one. We're just reviewing the CAT models. And then afterwards, we'll see what exact CAT models insurance companies want to use and approve or deny those. So that's kind of where we're at right now. Switching gears from kind of the 50,000-foot view of what's going on at the Department of Insurance, I think part of disaster preparedness and making sure that you understand what's going on with insurance is really understanding your coverages. I think the worst time to find out that you're underinsured is after you have some sort of catastrophe, natural disaster. Reports indicate that 8 out of 10 homeowners are underinsured. So simply put, if you have a total loss, you won't have enough money to rebuild your home. Andrea, my colleague, and I were at these workshops after these LA wildfires and seeing, homeowners that didn't know what their coverage were, didn't know that they had to, look over it every single year and found out, they don't have enough coverage to rebuild their home. Is really heartbreaking. So it's important to know exactly what's in your policy. Ask your agent, have those conversations with them. so that they can tell you exactly what you need. I think a lot of times we expect our insurance rates not to go up very much, but at the very least, they should be going up by the cost of inflation. So your insurance is priced by your home's rebuilding cost. And if it costs more year over year to rebuild your home, then your insurance should be going up by the cost of rebuilding your home at the very least. I mean, there's many other factors now that are causing far larger increases, but knowing what it costs to rebuild your home, that's a huge part of that. And it's important to note that, after a disaster, especially if there's a wider area that's been affected, building costs really soar in these areas. And because you're not building the same house you maybe bought 30, 40 years ago, you're having to rebuild a house with all these building code upgrades and all these different types of changes that it's not going to be the same home. So that also increases the cost of coverage. So those, again, are just some few things to look out for, especially when you're thinking of your insurance policy. And outside of this, a lot of people, I mean, they can't even find coverage. It's been a huge problem in California. So what do you do if you get a non-renewal notice? What are some of the first steps that you should take? The very first one is to contact your insurer. So if you get a non-renewal notice, contact your insurance company and ask them if there's any specific actions that you could take to mitigate your risk and retain your coverage. And you should ask for your risk score, your wildfire risk score. So a lot of people don't know this, but you are legally entitled to your risk score. The Safer from Wildfires regulation the commissioner passed in 2019 requires insurance companies to give you this score and tell you what went into it and how you can improve your score as well. So there's multiple times where you can ask for your score, but non-renewal is definitely one of them. If you're applying for a new policy, you can ask for your risk score. If you are renewing your policy, you can also ask for your risk score. And let's say you do any sort of mitigation on your home, you get a new roof or increased defensible space, home hardening, whatever that might be. If you do mitigation on your home, you can ask your reinsurance company or your insurance company to give you a new wildfire risk score. And you also have the right to appeal your score. This is something that we can help you with at the Department of Insurance. I've seen some crazy reasons why an insurance company isn't renewing your policy. I've seen photos of homes that aren't even yours that they're saying, have X amount of brush or whatever that is. So ask for your risk score, ask them for the photos they took, all that documentation you are legally required to have or legally entitled to have. And I think it's a really important note. And if you have any issues with actually receiving the renewal, so sometimes insurance companies will not give you a 75-day notice before the policy expires. This is California law. They need to give you at least 75 days to be able to find insurance somewhere else. Many times, if they don't give you that notice, then you're able to, then we've been able to work with them to get your non-renewal reversed. So again, important to note to ask for your risk score and also that you have 75 days at least. And if you've kind of exhausted your options on the traditional marketplace, the surplus lines market is there as well. These are your non-admitted insurers. So they're not backed by the California Insurance Guarantee Association, which means there's not as many protections if you have a claim. But that doesn't mean to write them off entirely. I think it's just important to and worthwhile to note that they might be based out of state, they might be based internationally, but they might be an option if you can't find that anywhere else. And if you've really exhausted all your other options, can't find anything on the surplus line markets or non-admitted insurers, or it's too expensive, then that's when the FAIR plan would come in. So the FAIR plan is supposed to be a temporary solution for standard fire insurance. Unfortunately, in many parts of California, it's become the only solution or only resort, but it's not a state agency. It's called the California FAIR Plan. It's a little bit of a misnomer. It is still a a consortium. It's a pool of private insurance companies. So if you have the FAIR Plan, you don't have a state insurance company. There's no public or taxpayer funding going into this. It is still private insurance companies. Unfortunately, it's a named peril policy, meaning it's only going to cover fire, lightning, internal explosion, and smoke damage. And the maximum coverage that they have for residential properties is $3 million, and that's for all coverages, additional living expenses, everything. So in San Diego, especially where homes can be far more than that, and if you're in a high risk area, that can definitely be an issue. But at that point, I would, again, look at the surplus lines market and also consider buying a difference in conditions policy, which is your companion policy that's going to cover other hazards like water damage and theft, because unfortunately, California FAIR Plan is not a comprehensive homeowners policy. We're continuing to, at the Department of Insurance, modernize the FAIR Plan. We're adding more coverage for commercial properties. It used to be $20 million for the entire structure or in the entire location, whereas now it's $20 million per structure and up to $100 billion. So larger HOAs and housing developers, larger businesses, there's more coverage there. But unfortunately, there hasn't been increases for the residential side. And we're continuing to add solvency protections and increase public reporting and accountability for the FAIR Plan. But it's kind of the FAIR Plan in a nutshell. If you can't find insurance anywhere else, that's where you would turn to the FAIR Plan. Now, I think we'll open up the floor for some general questions. If you have questions about a specific policy, don't know what's in it, don't know what your coverages are, we have a bunch of great dedicated agents that are able to answer your questions. So call 800-927-4357, 800-927-HELP. They will go over your policy with you. They're wonderful, speak a bunch of different languages. So it's a really great resource to kind of have in your back pocket if you're having some really specific issues with your insurance agent, policy, company, whatever it might be.
Thank you, Sharon. Thanks for that. And if you're just joining us, I'll go over it, put some questions in the Q&A down below. Also, we're recording this meeting so we can you send it to your friends, family, whatever, if you need to go back and look at something. And let me just start with kind of the simple, but probably the one we're asked the most, Sharon, is when are we going to see insurance rates return to normal level?
Yeah, I think normal is a hard one because by normal rates, I think if you mean the past kind of decades, I'm going to be honest, I don't see that. Historically, California's insurance costs have been low compared to its home values. I know it doesn't seem that way, but California has an overall lower insurance burden than most states. All other things held. So if you take out, actual home values and things, the insurance burden itself has not been as high as most states, partially because of Prop 103, partially because we have a prior approval rate process. Other states, insurance companies don't have to go through their Department of Insurance. They can raise rates and file it on the back end, or they don't have to get that approved at all. So I think that's kind of a big point to note for California specifically, that we've historically just not really paid for the amount and enough to mitigate the risks that insurance companies are taking on. The other part of this is that between kind of climate change and inflation, I think we do need to rethink what our normal is, what our new normal is going to be. The sustainable insurance strategy, the goal is to stabilize the market. So we're not getting these massive, just shocking increases year over year, but a downward trend in insurance. I'm not confident that that's going to happen if we're having greater global or greenhouse gas emissions and the climate is getting hotter and we're getting more of these climate related events. We see risk go up, losses go up, we're going to see these rates go up. So I'm not trying to kill the mood, but I think it's important to kind of situate it within these contexts of warming planet, inflation, and our regulatory market in California.
Supervisor, I believe you may have a question.
Yes, and thanks, Sharon, and thanks for the presentation. Very very detailed. I appreciate that. But one of the things, we're trying to do here in San Diego County is reduce the risk of wildfires here. After we saw what happened in Los Angeles, we're trying to reduce the risk, particularly of fuels, and trying to clear brush where we can, and having more fire equipment and trucks and things like that. Does that weigh in at all? If we do these efforts and maybe there's less risk in San Diego County because of the efforts that we've taken, does that play in at all to potentially lowering rates for San Diegans?
Lowering, I'm not sure if that would be the case, but getting more accurate rates and lowering risk in general is absolutely going to be paramount, especially when we're talking about the catastrophe modeling. Because before, insurance companies were only having to use those 20 years of historical rates. Like I said, that's caused those problems with not being able to incorporate all the mitigation that's being done. But with catastrophe modeling, these investments that are happening in San Diego County, and these investments that homeowners are making, that's going to be a part of these catastrophe models. So we should start to see this more kind of accurate rate, where what that risk is going to be is really going to be dependent on what these models say. I think that it's important to continue to do this risk mitigation because it's going to have tangible effects in these models. If we'll see it go down, I'm not sure. Just because we'll see what insured losses are. We'll see what risk is like in total. But when we're talking kind of on a county level, insurance companies aren't looking at just San Diego County. They're looking at California as a whole. They're looking at a far broader kind of context than just, county by county. Not to say that these things don't matter, but it won't necessarily bring them back, but in the context of just mitigating risk entirely and doing everything possible from home hardening, vegetation management, defensible space, and everything that the county is doing about decarbonization, minimizing greenhouse gas emissions, like all of those things are definitely going to contribute to lowering risk in general.
Well, one of the things that we brought forward in San Diego County, I think it was as a pilot program for people, that if they follow certain home hardening procedures, like getting brush away from the house and any other combustible things away from, having defensible space, having certain types of vents put in, and we were able to have potentially our fire marshal or Cal Fire fire marshal come out and inspect the home and see that it meets all, many of these criteria, that people could also give that to their insurance companies. And I know not all of them accept this, but that's a way to potentially, get your rates down if you've got all of the the home hardening efforts in place. And I know we're doing that in San Diego County and others. Another area we're looking at, or I'm looking at, is clearing these fuels. I know we've, and I know you're the insurance commissioner office, and you don't really, you don't have other areas, but a lot of our environmental laws, and yes, we want to protect the environment, but some of them have not allowed us to even clear out some of the high fuel areas. And that's, something I think we definitely also need to work on. So, we're looking at that here and trying to, because when the Santa Ana winds start blowing, we're kind of up a creek. But appreciate your thoughts, and I'll let you, Miles, I'll let you go back to the listeners' questions.
Yeah, so we've got some more questions. Sharon, are you familiar with the wildfire prepared program?
I am somewhat familiar with it. I will say this isn't it's not a state program. This is, it's a IBHS, it's an Institute of Business and Home Safety. So this is still, that's a institute, kind of think tank that's really closely aligned with the insurance industry. We have something that's it's very similar to the wildfire prepared program. It's called the Safer from Wildfires program. I talked about it a little bit when I was talking about wildfire risk score. This is what was passed in 2019. Andrea just posted some information about it, but it was an interagency kind of effort and a ground up approach to wildfire resilience. So the 3 steps in it were to protect your home, protect the surroundings, and then protect the community. So the first part of it was the kind of home hardening aspect. So installing those 1/16 to 1/8 inch non-combustible mesh screens that keep those kind of embers out of your home. That was part of it. Having the fire rated roof and the non-combustible 6 inches and having enclosed eaves, double pane windows. So that that kind of step, the protect your home, is very similar, I think, to the wildfire prepared program. So for that part of it, you complete all those tasks, you might qualify for discounts from your insurance company. I'm not going to say they're going to be massive discounts, but if you do have those things, check with your insurance company and see if they're able to get you those discounts. So it's protect your home, protect the surroundings. So that's your defensible space, the 5 feet. That's really critical. That prevents fire from getting a foot in the door. So that's another part of the component, and also moving any sort of sheds or outhouses at least 30 feet and at 30 feet away from the main building. So that's step 2 if you qualify within that, or for any of those kind of mitigation efforts. Then again, contact your insurance company, see if there's any discounts that you can get. There's not a standard, unfortunately, like you're going to get 10 if you do this, 5 if you get this. But they will recognize it to some degree. And then the third part is I think really critical, and something that doesn't get talked a lot often, because you can do every single thing possible to protect your home. But if you don't have that on a community level, and back to what we were saying about, San Diego County doing everything, we really need that statewide buy-in for wildfire mitigation just throughout. So the community level mitigation can be done through Firewise USA. These communities are sometimes as small as 8 dwellings or as big as like 2,500, and they create action plans to be able to mitigate homes. And it's a nationally recognized program with proven results. It's sponsored by the National Fire Prevention Association. So if you do have a community that is really engaged, really wants to do this, consider forming a Firewise USA community. You can reach out to us, or you can go directly to the Firewise USA website. But most insurance companies, if you're in a Firewise zone, they will get you some sort of discount for that. So I've helped a few communities that were fire safe councils try to get that Firewise designation.
Talk about the FAIR plan and
Yeah.
full transparency. We're on the FAIR plan because we got insurance canceled. So I could be on here just even if I wasn't working tonight.
Yeah.
We heard the articles and tell me where basically one of the questions we had is what's the status with the FAIR plan? We see the devastation up in LA, and then we've heard, oh, it's going bust, there's no money.
Yeah.
And people who are on the FAIR plan, myself included, are thinking, well, shoot, if my house burns down, is there any money left for me? So
Right.
can you give us an update on that?
Yeah, absolutely. No, I think that's a really legitimate concern, especially with a lot of the financial instability that was going on after the LA wildfires. Right now, what the FAIR Plan is doing, you might have heard they're assessing their members. So what they basically did is ask their members for $1 billion to cover the losses from the Los Angeles wildfire. Those $1 billion are basically split up amongst the market share of their member companies. Remember, I was talking about how the FAIR Plan is a pool of these insurance companies. Based on their market share, they're going to pay out this $1 million. These insurance companies are able to recoup up to 50%. So in this case, would be $500 million from policyholders. So what that's actually going to shake out to for each person or policyholder, it depends. It's actually getting litigated now. I don't know what it's going to be. There's consumer groups that are trying to block the assessment now. So I'm not exactly sure what that would look like. It's really unclear. But that's kind of the status. So as far as the FAIR Plan financiers are concerned, the LA wildfires were a significant payout. They did have a lot of exposure there, but they are going through their claims. They're paying those out. There's still concerns of financial instability right now. There's AB, I think it's 226. It's currently being reviewed by the Assembly, and this bill would allow the FAIR Plan to issue cat bonds, or would assist them in issuing these catastrophe bonds. And this helps them finance insurance claims payout. So we're trying to shore up the FAIR Plan and make sure that this kind of credit access could overall strengthen the FAIR Plan's financial position. But before the LA fires actually listened to the LA or the Fair Plan president actually testify in front of our state senators, I believe, and they explain the process of the Fair Plan. And for it to actually go bankrupt and actually go bust, it would take them bankrupting State Farm, Travelers, every single big insurance company in the state. That's not a risk right now because they have these mechanisms to assess and ask for the member companies for money to recoup. That's not as large of a concern right now. So there's things in place to continue to make to overall strengthen the Fair Plan's financial assessment and or position, and then we'll kind of see where the litigation shakes out with this assessment that's going on.
Miles, you're muted.
Sorry, first time on Zoom. Sorry, Sharon, this question you've kind of addressed it already, but I think it's like the most vital one that people are going to keep asking. And we got this from someone, I believe in our district. Our insurance has tripled in the last 2 years. If it continues to increase at this rate, we will literally be priced out and forced to move out of state. What are some actionable options we have to prevent this? I know you went over some, but if people are just joining us, or can you be specific with some of those?
Yeah, absolutely. If you would put the safer from wildfires, if you can't see that already, Andrea had just put that a few comments above. But the protecting the home, so the home hardening aspect of it, that's the enclosed eaves and the double pane windows, Class A fire rated roof, all of those kinds of actionable steps that protect and harden the home. The defensible space part of it is another huge component, and then getting your community involved, creating fire-wise communities, creating fire-safe councils, really engaging with your neighbors so everyone is on the same page when it comes to wildfire mitigation. And then when it comes, I kind of touched on it with California's insurance burden, but I do get that question a lot of getting priced out of the state because of insurance. And I think there's some home kind of affordability concerns and kind of like housing density concerns that's kind of out of my wheelhouse. I'm not dealing with that. I'm on the insurance end, but I think it's important to note that other states are feeling the pain too. Like no state is not burdened by climate change and seeing this reflected in insurance. Some of the states that have kind of the cheaper housing, as you would say, like you think of like Oklahoma or Louisiana, Texas, Florida, all of them have the highest insurance premiums as well. So it's something to really know kind of about California. It's like the home and the housing is definitely expensive, and that leads to kind of expensive rates, but in proportion to home values, we are not paying that much in insurance, which I don't know if that's better or worse, but
Yeah. We got another question here. Again, someone in our district. Why can't we cap how much insurance companies can increase each year? At the current price of rate increase, I'll be paying $15K in a year or in 5 years.
area. I mean, that was one of my first questions when I started the Department of Insurance, but it's not something we have any legal authority to do. That's kind of the end of. These are private companies. They're looking to make a profit. They're not an SDG&E that has to offer you electricity. They're not nonprofits that are doing this kind of out the kindness of their heart. They're looking to make a profit. And if they're seeing that the risks outweigh what they're going to gain, if the losses are too high, then they don't write it. And right now, the way that they're looking at this is that because of kind of our regulatory market, and we weren't able to, our insurance companies weren't able to take into account catastrophe modeling or climate change, and they weren't able to incorporate reinsurance costs. They're saying we're taking on more risk, and we can't actually, like, they couldn't financially support the risk they were taking on in California, which has led the insurance commissioner to, do all these reforms that I've talked about. But the kind of reason why it hasn't been so high is also the reason why insurance companies pulled out of the state. So it's a delicate act. I know it doesn't bring people much solace to be like insurance companies aren't making enough money. I know that. I'm not here to defend them, but it is important to kind of know how to balance insurance availability and the insurance affordability and consumer protection. It's something we are constantly thinking about at the department.
I want to throw one question we got in the chat,
Mhm.
and another. This is something that's vital to people. What if you can't afford the fair plan? Those aren't super cheap depending on where you're going to be. So, say your insurance cancels you, you're sitting there going,
Mhm.
"I got to get something," and then they cancel you, and then you look and you get some $6,000-7,000 bill. Is
Yeah.
there what can
Yeah.
people?
The I would ask your fair plan at that point what sort of mitigation options that you can do, and then talk to your agent about like deductible changes, like what kinds of structural things in your policy they can change to make your overall premium smaller. But that's a huge concern of mine as well. Like I've had people come up to me saying they're seniors that are on fixed incomes, and I can't make those payments. And absolutely, it's generally an awful situation to be in. But I would say contact your agency if there's anything that they can do there on that end of increasing your deductible. um what sort of mitigation that you're doing. Is it that you have an older roof? Is not enough defensible space? What are the things that are causing kind of the risk to be higher in your um home? But yeah, I mean, outside of that kind of mitigation part, there's not going to be a ton that can be done for a homeowner, unfortunately.
That is unfortunate. Yeah,
Yeah,
because
yeah.
we're doing the same thing, which you touched on.
Mhm.
How can we find out if an insurance company has designated the zone where our home is located as a high fire risk hazard zone? Is there?
So, yeah, I think this is an important point, that hazards and risk are two different things. So hazard, that's what CAL FIRE has, like your hazard maps that come out every single year. CAL FIRE works on hazards. And when you take these like CAL FIRE hazard maps, that's not um that doesn't necessarily translate to what your insurance company is assessing as your risk. So a hazard is just helpful, or the hazard maps are really helpful for like state planning decisions, knowing where to get firefighters and things, but it's not so helpful for a homeowner to know what the hazards are. They want to know what their risks are. So back to my point about the wildfire risk score, the Safer from Wildfires regulation allows you to ask for your risk score those 4 separate times. So if you're renewing a policy, applying for a new policy, have been non-renewed, or are doing some sort of mitigation. So if you've done mitigation on your home, and you have 30 days to let your insurance company know and know what your wildfire risk is. So knowing your risk is important, far more important for insurance purposes than knowing your hazards. If that makes sense.
Yeah, thanks for that update. Just going through some legislation. Uh, what and I don't know if I asked this, but what needs to change in order for Californians and all insurance markets to come back once again? I know we kind
Yeah.
of touched on that, but how do we
Yeah.
get back? I mean, it's kind of that first question we asked of how does this become normal again, but
Mhm.
what needs to happen from your
Yeah. I mean, from our office end, the regulations that we put in place were all things insurance companies wanted for decades. Like I said before, these are things other states have been doing, and that because of our regulatory framework in Prop 103, we didn't have the ability to do up until the commissioner sponsored this regulations and have put them into place. So catastrophe modeling is huge because it allows these kind of mitigation efforts to be really taken into effect from the governor, from homeowners, from communities. Those are the types of things that are going to be in these CAT models. And then reinsurance costs. Those were two big regulations, two things that insurance companies have said they've needed to get back to writing in California. All states said after we're done with the catastrophe models and have approved them, they're looking to write in all corners of the state again. So these are things insurance companies have been asking for, and we're getting them in place now. It's the wheels of government turn really slowly, but we are working on everything possible to get these in place so that homeowners can actually start seeing these more accurate rates reflected in their policies.
one question we've gotten actually a couple times is what are the insurance companies saying? Like, what
Yeah.
are they telling you guys?
Yeah. I mean, a lot of times what they're saying is that they're not collecting enough premiums to basically cover the risk that they're taking in California. And it kind of always comes back to this balance that we're trying to strike with insurance companies, because we want them to continue writing, but we also need to make sure that consumers are able to afford this. So it is, they're saying we need to charge more, and we're saying you need to justify these charges, and you also need to write more in these high wildfire areas and take into account all the mitigation that's being done, if you want to use these tools. So that's kind of the agreement that was struck in the sustainable insurance strategy, was like, if you want to use these tools, commit to writing at least 85% of your market share in these wildfire distressed areas. And we'll continue seeing kind of what these wildfires distressed areas are. And I think it's on a biannual basis that we review if they've actually increased writing in these areas, if they've taken people off the FAIR plan. So it's not going to be something that's going to be, I don't think there's any sort of silver bullet or, magic fix that's going to get things just back to normal. There's not going to be a regulation that's just going to just fix all of this. But I think these were really big overhauls in our regulatory system that insurance companies really needed to write in these high wildfire areas. So yeah, I think those are two big ones.
We're going to wrap this up, and
Yeah.
I encourage everybody, if we've seen some questions, we are recording this. We'll send this to you guys after. Please keep writing into our office and we'll work with you, Sharon. What can you kind of wrap it up with, like a parting word, and then we'll hand it over to the supervisor here at the end. But in any resources, again, for people who can't get a hold, can't get insurance,
Yeah.
all the stuff we've talked about.
Absolutely. I would say reach out to our department. We are not going to charge you for our advice. We are a state agency. So reach out to our department if you have questions. There are times where we're able to liaison with your insurance company. You write off like, hey, I'm going to allow this compliance officer or this person from the Department of Insurance to be the one that's the point of contact with my insurance company. We're there to help consumers. We are one of the largest consumer protection agencies in California. So use our services. We're here to help. If you can't find insurance, if you're having issues with your insurance company, we're here for that.
Wonderful. Well, Supervisor, you want to wrap us up here?
Sure. Well, I want to thank everybody for joining us and for coming on. We've got over 100 people on this call here. Your voices really do matter, and this is really kind of hard to handle, and unfortunately, not a lot of hope at the end of the tunnel here right now. This insurance crisis has been, as Sharon had said, been years in the making with the complex regulations. I wasn't aware of Prop 103, but now I know a lot more about it. And unfortunately, the propositions in California, they'll trick you if you vote yes and trick you if you vote no. So it's kind of difficult. But I think the market's left way too many homeowners behind. And even as Miles says, he's part of the FAIR program because they had their insurance canceled. I'm sure a lot of you on here either had your insurance canceled or close to it. But it's encouraging to hear that the insurance commissioner has a plan. But I know just like anything in government, why is it taking so long? And I agree the cost of living in California, is out of control. I know much of you are in high fire risk areas. My deductible on my house on my fire insurance is $50,000. I raised it up to the max I could possibly get it to keep the prices and the rates down. But the status quo is just not sustainable because people are losing their houses or can't afford to stay in them. And I know while this is a state regulated issue, we're going to continue everything we can do here in San Diego County to advocate and clear fuel, push for reform, and explore local options to try to keep everybody as safe as we possibly can. When 100-mile-an-hour Santa Ana winds blow, all bets are off, unfortunately. But just know that I'm going to try to keep working as best as we can on the issue locally to keep people safe with equipment and clearing. I think more land management and fuel management needs to happen. Especially since it's taking so long to get some of these things in place. But if you have any other further questions, don't hesitate. This isn't meant to keep or have people stop calling my office about it, I'm happy to help out or share. But thanks for coming in tonight and listening, and reach out anytime. And hopefully the more we understand, hopefully the better we can fix this in the near future. So Sharon, thanks again for being here tonight. Miles, thanks for moderating. And we'll try to dig ourselves out of this one eventually, but we're going to keep working. Thanks a lot. Take care. Good night.